Welcome to the Deep Dive. We're here to try and cut through some of the noise, make sense of just how fast everything seems to be changing.
It really does feel like that, doesn't it?
Yeah, the global economy, tech breakthroughs, even, the way we talk about things publicly, it's a lot.
It is. And the sheer amount of information, well, it can be overwhelming.
Exactly. So that's what this deep dive is for. Our mission really is to pull out the key insights from the latest sources we've gathered.
Right. We've got market analyses, tech reports, consumer finance updates, political commentary, all really fresh just from the last day or two.
And the goal is to connect those dots for you. Market shifts, these big tech partnerships, how consumers are behaving, the political tremors.
Basically equipping you with what you need to feel genuinely informed about what's shaping things right now.
So let's dive in. Where should we start?
Let's kick off with the economy, specifically the Federal Reserve. They made their move this past Wednesday, September 17th.
Right, the rate cut.
Yep. They lowered the benchmark interest rate by 25 basis points, pretty much as everyone expected.
And Chairman Powell, he framed it as a, quote, risk management cut. Right. Trying to say the economy isn't actually weak.
He did. That framing is important, trying to sound proactive, not reactive. But honestly, the really interesting part was their future outlook.
Oh, what did they signal there?
Well, they hinted at maybe 2 more cuts before the end of this year.
Okay.
Another one possibly in 2026 and one more in 2027. But here's the big thing. No cuts projected for 2028.
None at all for 2028. What does that suggest?
It suggests they're bracing for maybe a new normal, a period where the cost of capital stays higher than we've gotten used to over the last decade or so. That could fundamentally change the investment game.
So how did the markets actually react? Because Wednesday itself was pretty choppy, wasn't it? The S&P actually closed down.
It was volatile, yeah. That initial hesitation wasn't a huge shock. But then Thursday, we saw a definite rally.
Okay, things picked up.
Big time. S&P 500 climbed 0.5%, NASDAQ popped over 1%, the Dow jumped 181 points, all three hitting new intraday highs.
And I noticed the Russell 2000, the small cap index, it surged over 2%. Hit records too. Why do small caps often get such a big boost from rate cuts? It seems a bit counterintuitive sometimes.
That's a great point. It really comes down to how they're funded. Small cap companies, you see, they often rely much more heavily on borrowing loans, credit lines for their day-to-day operations and growth.
Right, unlike bigger companies that might be sitting on cash.
Exactly. So when interest rates fall, their borrowing costs go down noticeably. That can directly boost their bottom line, their potential to expand. Larger firms are just less sensitive to those shifts.
That makes sense. And speaking of market takes, I saw that quote from David Tepper at Appaloosa. He said something like, I don't love the multiples, but how do I not own it? I'm not ever fighting this Fed. What's he getting at with multiples?
So multiples refers to valuations, how expensive stocks are compared to their earnings or cash flow. Tepper's basically saying, look, stocks might look pricey based on fundamentals, but with the Fed signaling easier money, it's really hard to bet against the market going up. It captures that tension perfectly. But he also warned, the Fed could end up overheating things if rates go too low. It's a fine line.
And that tension seems to exist within the Fed too, right? Yep. The vote was 11-1 for the cut, but the dot plot, that showed some real disagreement.
Oh, absolutely. That dot plot, where officials anonymously project future rates, showed significant differences in opinion, not just on rates, but on forecasts for GDP, inflation, unemployment. It's definitely not a united front over there.
So what are some economists reading into that?
Well, some, like Jack McIntyre at Brandywine Global, they're suggesting the Fed might even be expecting something like stagflation.
Stagflation, you mean higher inflation and a weaker job market?
Exactly. And McIntyre points out that's not a great environment for financial assets. So it paints a picture of some real challenges ahead.
Okay, so the Fed cuts its main rate. You'd think borrowing costs for consumers would drop. But mortgage rates actually went up. How did that happen?
Yeah, that's a classic market paradox, isn't it? It happens because mortgage rates follow long-term bond yields more closely.
Okay.
And the bond market, if it thinks the Fed is being too easy on rates, and that might lead to future inflation or maybe stronger growth down the line, it pushes those long-term rates higher. That expectation can completely outweigh the Fed's immediate cut for short-term rates.
So the bond market's looking further ahead. Fascinating. And this obviously doesn't happen in a vacuum. What about globally?
Well, across the pond, the Bank of England met on Thursday, too. They held their key rate steady at 4%. That was widely expected, but it did cause the British pound to dip a bit.
And connecting back to tech for a second, there was news on crypto ETFs.
Yes, the SEC revised some rules. Seems like they're paving the way for new spot crypto ETFs to launch soon, this coming right after the Fed's decision. It signals maybe a broader acceptance, integration of digital assets into the mainstream financial system. A big step for crypto.
Okay, so from those big economic waves, let's pivot to tech and this AI revolution. Some really surprising partnerships happening. Intel and Nvidia teaming up.
Huge news. Nvidia announced a massive $5 billion investment in Intel. These are companies often seen as rivals, right?
Definitely.
This signals, I think, a strategic realization about interdependence. Building these AI chips is incredibly complex, incredibly expensive. NVIDIA's CEO, Jensen Huang, called it an incredible investment. They want to combine Intel CPUs with NVIDIA's GPUs and networking tech.
So Nvidia becomes a big customer for Intel CPUs and a big supplier of GPU chiplets back to Intel.
Exactly, leveraging each other's strengths and the market. It went wild. Intel shares shot up, 26 to 30%?
Wow. That's a massive vote of confidence, especially after Intel ousted their previous CEO, Pat Gelsinger. A big win for the current CEO, Lip-Bu Tan, and his turnaround plan.
For sure. Tan's been laser-focused on cutting costs, raising cash, the GPS Act money from the government, that SoftBank investment, selling assets, workforce cuts.
But they cut like 15% of their workforce.
Yeah. So this NVIDIA deal is a huge piece of that puzzle. Interestingly, there was also a report that China banned NVIDIA's AI chips.
And how did that play out?
Paradoxically, it actually boosted other Asian chip stocks. SK Hynix, TSMC, Samsung. They all saw gains, maybe investors shifting bets within the sector.
Shows just how tangled and reactive that whole global chip supply chain is. Meanwhile, Google's not sitting still in the AI race either.
Not at all. They're putting their Gemini AI directly into the Chrome browser.
For everyone, like Mac, Windows, mobile.
Yep, rolling out in the US first. It's meant to be a proper browsing assistant, help you understand websites, work across different tabs, even do tasks within a single tab, like scheduling a meeting from an email thread or searching YouTube easier.
And they're talking about more advanced stuff coming too, like AI agents that can book things for you.
That seems to be the next step. Booking haircuts, ordering groceries, directly via the AI. This is really Google fighting back hard against rivals like OpenAI and Perplexity, who are also pushing into AI browsers and agents.
It's a real battleground. And on a side note, Google got some good news from China, too.
Yeah, reports suggest China dropped its antitrust probe into their Android system. Shares ticked up a bit on that.
Okay, so that's consumer-facing AI. What about AI for businesses, the enterprise side?
Seeing really strong momentum there. Take Notion, the productivity software. They've hit $500 million in annualized revenues.
$500 million.
Wow. And a lot of that growth is apparently thanks to their early push into AI features. Over half their customers are using the AI add-ons now. It shows AI is becoming a core part of these work tools.
That's serious adoption. And cybersecurity seems to be booming with AI, too. CrowdStrike had a good week.
They did. Stock popped almost 13%. They gave really positive long-term guidance, announced a partnership with Salesforce, and bought an AI security startup.
So AI is both the threat and the defense tool in cyber.
Pretty much, and the whole cybersecurity market is just red hot. Look at Netscope. They just had their IPO on NASDAQ.
Netscope, right. How did that go?
Opened at $23 after pricing at $19. Valued the company around $7.3 billion. And get this, the IPO was oversubscribed more than 20 times. Massive investor appetite there.
20 times oversubscribed. Tells you something.
Definitely. And even established players like Workday, their CEO, Carl Eschenbach, said AI is a tailwind for them. They're using their huge user base, 75 million users, and all that curated data to build AI solutions. Even got a big vote of confidence from activist investor Elliott Management, who took a $2 billion stake.
So AI is clearly driving huge investment and growth in the enterprise space. Okay, let's shift focus again from corporate spending to, well, us, the everyday consumer. How are these bigger economic forces playing out in personal finances?
Well, one place you really see it is the luxury market. There's a fierce battle for high-end customers. American Express just revamped its Platinum card.
I saw that. Raised the annual fee quite a bit, didn't they?
They did, up 29% to $895 a year.
Oof. From $695.
Yeah, but they've also boosted the perks significantly, now offering $3,500 in annual benefits, supposedly, mostly credits for services. Uber, Lululemon, Aura Rings, Resi Restaurants.
And Dell and Adobe for the business card.
Right. It's really heating up that arms race between Amex, Chase, Citi for the big spenders. Now, some people call it a coupon book approach. You have to really work to use all those credits.
True. You have to be diligent.
But Amex says they're rolling out a new app feature to make tracking and using the benefits easier. But the key takeaway here, I think, is what it says about who is spending.
What do you mean?
Consumers in the top 10% of income earners. They accounted for about half of all consumer spending in the second quarter. That's the highest level in over 30 years.
Half of all spending from the top 10%.
Yeah. So this focus on luxury cards, it reflects where the spending power is concentrated right now. That wealthy segment is driving a lot of the growth.
And you see that in other areas too, like car sales, right?
Exactly. The sources say higher income buyers are basically propping up car sales. The share of new cars selling for over $50,000 is almost double what it was back in 2019. A really stark difference.
It shows that split in the market. What about everyday spending, like dining out?
It's a mixed bag there, too. Darden Restaurants, they own Olive Garden and Longhorn Steakhouse.
Right.
Their Q1 results were okay, not great. Earnings missed estimates slightly, but their same-store sales were actually up almost 5%, boosted by those casual dining brands.
But people are still going to Olive Garden.
It seems so. Darden's strategy seems to be working, keeping menu price increases below the rate of inflation and using delivery partners like Uber effectively. They're attracting those more price-sensitive customers.
Smart move in this environment, but not everyone's succeeding there.
No. Cracker Barrel, on the other hand, they missed earnings estimates, saw traffic decline, and gave weak guidance for future revenue. Their stock took a pretty big hit. Shows that just being perceived as value isn't always enough. Execution matters.
Definitely. Okay, shifting to something that hits very close to home for many homeowners.
Yeah.
Property taxes.
Yeah, this one's painful. Homeowners are paying, on average, over 27% more in property taxes than they were in 2019.
27%, that's huge.
And get this, 2/3, 67%, said their tax bill this year was higher than they expected.
I believe it. My own bill certainly surprised me this year. It really drives home how these macro trends filter down. Is there anything people can actually do?
Well, financial experts suggest some basic steps. Look at your past tax bills. Check how your local tax base is growing. Know when your property might be reassessed.
Okay, be proactive.
And maybe budget an extra 5 or 10% on top of what you estimate your bill will be, just to be safe, especially since those median bills vary so wildly, over $9,000 in New Jersey, under $800 in Alabama.
Good advice. On a slightly more positive note for some taxpayers, New York State is doing something interesting.
Yes, they're sending out inflation refund checks. It's a first ever thing for them.
An inflation refund.
Yeah, a one-time payment, $150 to $400, going out to over 8 million eligible taxpayers starting late September. It's possible because the state collected more sales tax revenue because of inflation.
Huh. So inflation created a surplus, and they're giving some back. What are advisors saying to do with it?
The usual sensible stuff: boost emergency savings, pay down high-interest debt like credit cards, or maybe invest it if you're already covered on the basics. It's a direct response to help households cope.
Interesting policy response. Okay, let's pivot one last time to the political arena and the media landscape. Because, wow, this week felt particularly intense on that front. The Jimmy Kimmel situation.
Yeah, that escalated quickly. ABC pulling Jimmy Kimmel Live off the air indefinitely.
And this was after comments he made linking the alleged killer of Charlie Kirk, the conservative activist, to Trump's Magier movement.
That was the trigger. Then FCC Chairman Brendan Carr weighed in very publicly, saying Kimmel seemed to have misled the public on a significant fact. Court documents from Utah later indicated the alleged killer actually leaned more to the left.
And President Trump praised the suspension. This feels like part of a bigger pattern, doesn't it?
It does, especially when you consider Carr's comments before the suspension. He reportedly warned ABC something like, "We can do this the easy way or the hard way. Take action on Kimmel, or there is going to be additional work for the FCC ahead."
That sounds like a direct threat regarding their broadcast license.
That's certainly how many interpreted it. Plus, you had major station groups like Nexstar and Sinclair preempting the show. It all points to significant political pressure being applied.
So what are the broader implications here for media, for free speech?
Well, it's raising serious questions about media independence. We saw House Democratic leaders calling for Carr's resignation, accusing him of corrupt abuse of power. Former President Obama also spoke out against threatening regulatory action against media, calling it the kind of government coercion the First Amendment is meant to prevent. It really highlights this ongoing tense relationship between the current administration and major media outlets.
And that pressure extends beyond just media, right? There's tension with the Federal Reserve, too.
Yeah. Yes, definitely. The administration asked the Supreme Court to allow them to fire Federal Reserve Governor Lisa Cook
over those alleged mortgage fraud claims, which she denies.
Correct. Lower courts have blocked her removal so far, which is why she was actually able to participate in the Fed meeting this week.
It underscores that push and pull over the independence of these institutions. And Trump has appointed people to both the FCC and the Fed recently.
Right. Carr as FCC chair and Stephen Mirren confirmed as a Fed governor, who also attended the meeting. Some commentators, like former Dallas Fed President Richard Fisher, suggest Trump might be looking for a scapegoat in his ongoing disagreements with Fed Chair Powell.
Shifting to the global stage quickly, President Trump was in the UK, met with Prime Minister Keir Starmer. Any news on the diplomatic front?
He hinted at potential good news regarding the Russia-Ukraine war, while also admitting it was harder to resolve than he expected. More concretely, he praised the special relationship with the UK and announced a groundbreaking deal.
A trade deal.
Seems like it. Favorable tariff rates for the UK, a 10% blanket tariff on British goods. Described as favorable, along with announcements of about $150 billion in foreign investment coming into the UK. It fits his preference for bilateral deals.
But aren't his broader tariffs facing a legal challenge?
They are. The Supreme Court is set to hear arguments on November 5th on a major case challenging his authority to impose those reciprocal tariffs. This could impact tariffs up to 50% on goods from many countries, including China, Canada, Mexico, a potentially huge decision for global trade.
Okay, one last item. Kind of a different type of empire building in sports.
Yeah, Ted Leonsis, the owner of Monumental Sports and Entertainment, that's the group with the Capitals, Wizards, Mystics.
Right, valued at almost $8 billion.
He's making a serious push to add more DC teams, specifically an MLS soccer team and the Washington Nationals baseball team.
To trying to build a DC sports empire. What's his angle?
It's fascinating, actually. He views his company, MSE, less like a traditional sports group and more like a tech company or a branded platform company, like an Oracle or Salesforce.
A platform company. How does that apply to sports?
His idea is to plug new teams into this shared platform, shared resources, marketing, data analytics, ticketing, all that stuff for greater efficiency. They're already doing $750 million in annual revenue, aiming for $1 billion within 3 years. It's applying that tech platform model to a very traditional industry.
Interesting model. Though buying teams isn't easy these days.
No, he mentioned offering $2 billion for the Nationals, but the current owners aren't selling, partly because valuations have just gone sky high. He even admitted he probably couldn't afford to buy a team today without taking on significant debt.
Well, we've certainly covered a lot of ground today. From the Fed's tightrope walk with interest rates,
to the AI explosion, those surprising tech partnerships, how consumers are navigating costs and luxury.
and this really charged political atmosphere impacting everything from media companies to the Fed itself.
And as we connect these dots, what really jumps out is just how interconnected everything is, isn't it?
Totally. Fed rate decisions affect your property taxes, maybe even your car purchase. Political pressure in D.C. ripples through news coverage or global trade talks. The AI race isn't just about cool tech. It's about market power, national strategy, influencing everything from huge data centers right down to, well, how you find a recipe online.
It's all woven together in this incredibly complex system that's just constantly shifting.
So for you, our listener, maybe something to chew on.
Yeah.
How do all these threads, we talked about a fancy credit card update, semiconductor deals, the media debates, how do they all point towards this bigger story about economic power, the speed of technology, and just what influence even means in 2025?
And maybe more personally, what could these shifts mean for your finances, your job, or even just how you navigate the news and information you consume in the months ahead? Something to think about.